All right, and that is the end of the stream timer. So we are gonna get into it after I fire off one tweet really quickly to see if we can get a few more people in here. Because as always, it's a little bit better, the more the merrier when we've got some ideas to bounce off of people and get some more ideas in the stream for us to talk about. So give me 1 second to do that. All right. So if you're with us, let us know in the chat. We'd always love to hear from people. Jules, welcome. And KK for Life 13, thank you for the follow. Let's I guess don't have a ton of people on right now. This deal that we went through, but 1 second. Let me put one more message in the Discord server. All right, let's get into it. Again, we're probably just going to start this off the way that we did, yesterday, going through what's been going on so far. This has been an awesome week for us, and for whatever reason, the Google Finance functions aren't working, so I've had to re-input all those numbers manually. So 1 second. Appreciate the follow right there. KTU 2001. Hopefully it's not, I pronounced that one all right, and it's not KTU or something like that, but we'll roll with KTU. Thank you for the follow as always. And then let's see, S&P 500 ETF SPY finished up at 393.53. So, and I could probably zoom in a little bit more to make that a little easier to read on everyone who's watching. So right now it's Thursday night. We've got 1 day left in the week. We always like to consider Fridays in here for us as paydays because that's when a lot of our options expire. As you can see, we've got only a couple that are expiring this Friday. We've got PSTH March 12th, 29 calls. Those are probably going to expire worthless, which would net us another $120 basically for free. So that's always something that's nice that going into these Fridays. We've got Apple 128 strike puts. Those are pretty far in the money, so we're going to roll those over to March 19th, hopefully for a credit as we try to get our break-even price on that further and further down. The trade started, well, I guess we've still got all these that are messed up. It started at 128.5. Let me pull Thinkorswim up into the window here. As we can see, Apple finished up when we scroll up at 121.96. So if we input that right here, 121.96, we'll see that it's dropped 5% on us, which is obviously not the greatest, but our break-even price is 125.4. So hopefully with the stock that's as strong as Apple, we'll be able to have that one pop up a few more dollars for us and break even on it sometime soon. Hoping, we can maybe get a sneak peek on what the credit will be, but I looked at it today. Hopefully it's somewhere in the 30 or 40 cent range. So hopefully we can get this down to about 125 on the number and just keep rolling. Thank you, James Pope 98 for the follow as well. I know that's one from the Discord. Threw me off a little bit having a slightly different username. I was ready to go all in on the James Poop 98 call out, but let's keep it rolling. Again, if you guys have any questions, feel free to throw them in the chat. We've got questions about GameStop predictions for tomorrow, and honestly, we could start off with that if we want to talk about GameStop. So let's pull up GameStop's chart. So as anyone who's been paying attention knows, we pulled the 1 day up and you could still kind of see a little bit of what was going on there yesterday as we had the drop from 348 to 172, where luckily we entered over here. Just full disclosure about what we're holding. We're short on game right now, which obviously isn't something a lot of people like to hear because, there's this big time hype train around GameStop. People are hoping it goes super, super high. And in the short term, I think that's definitely still a possibility, but our position right here is essentially saying that on April 16th, GameStop is going to be below $310 a share. So essentially, if we zoom out here, we're just playing it to stay below here a month from now, which even if it squeezed up to 500 again and came all the way back down, we think it would do so within a month. So that isn't necessarily us saying that there won't be a squeeze at some point here in the near future. It's just us saying that we think by April 16th, things will be settled. But as far as our predictions for tomorrow, let's zoom into the 5-day to get a little bit better of an idea about maybe what we can expect. And what's interesting here with the price action, Zooming back out again, we're going in and out, snip, snap, snip, snap. On that first squeeze that we had right here, it was just this super intense upward movement. We could even zoom in on this section of it right here, where you've got this huge green candle, another huge green candle, and then that huge open on January 28th, which took it up to 500 before it inevitably sold off pretty quickly over the next 3 or 4 days. And that is typical with what you'll see on a short squeeze or something of that nature. But when we look at the price action we've had on this one, we have this big green candle. But if we mimicked what was going on with the previous short squeeze, we would have seen another one here and then another one here way up off the screen. We could zoom out on the y-axis here and we'd be up here around February 26th, March 1st, somewhere in that range. What has been interesting to me about this time around with GameStop is the fact that it's kind of had a slow upwards grind as opposed to these just huge green candle after green candle after green candle, which is typical with what you would see in a short squeeze. So that's something that does lead me to believe there may be a little more juice left in this one. As far as a day-to-day prediction, it's always tough to say, I think it's going to go up X% on this day at this hour, because I know a lot of people try to make big predictions like that and say things for clicks, because obviously GameStop is a pretty hot stock right now. But at the end of the day, no one has any clue what's about to happen. And if they did, they probably wouldn't be doing what we're doing here. They'd be living, like we say, on an island somewhere, because they'd be making a lot of money from that type of thing. And again, I think I might be dropping a few frames here. So if you have any connection or quality issues, feel free to let me know in the chat, and I could do what we did last night where we reset it. But I think right now we're back in action. So anyways, back to the point that we were talking about with GameStop. Like we mentioned, if it were a normal short squeeze, we'd see it way up here somewhere on our screen, way up off of what we've zoomed out on. And it probably would have fallen back down by then. And the fact to me that GameStop has gone up to 260 and kind of remained in this elevated level above 100 for so long. I mean, obviously there was a big candle from 50 up past 100, and then another big, not even necessarily one large individual candle, but just a really nice sustained upwards move where it did start getting a little bit out of control, and it was quickly knocked back down by one of, I think, maybe the biggest single intraday price movements during this whole thing over such a short period of time, when it went from 348.50 at the top to 172.06 at the bottom right there, which was some pretty crazy price action. And then what is even more surprising from my perspective is the fact that you have this huge action, which might make you think, okay, this is probably the end of the road for GameStop. Everyone's selling off. But the next day it trades within a $30 or $40 range, which, don't get me wrong, is a pretty wide range. But for the volatility that we've come to expect from GameStop, this is a pretty steady trading day. And if I had to put my money on it and make a guess, I would say sometime in the next week or so, we could see another leg upwards if this loads really quickly. And how high that will be, that is anyone's guess. I know we did mention on the stream, I think on Monday night, that we said if it broke 200, it would see 300 pretty quickly. And that definitely came true. And again, that was just maybe an educated guess based off some technical analysis and things that we're familiar with seeing and patterns in the market. We didn't know it was going to happen, but that's what we guessed. That one came true. If we had to make a similar prediction, I think we could be pushing 300 again sometime soon, just due to the fact that this sell-off was bought up relatively quickly. At this point, everyone knows that GameStop is overvalued on a fundamental basis. It's really just a big game of musical chairs. With the position that we've set up, we think by April 16th, all this is going to be resolved and it'll be below 300. But I think in the next, 5 to 10 days, next week or so, it could be anyone's game out there. And for us personally, if you wanted to get in at 260, I would maybe be a little bit hesitant. I think this advice would really only apply to people who currently hold positions and are looking for an exit, because we all know in the long run it's going to end up going down. The question is, if there's this big squeeze up to $500 or $1,000 in the meantime. But for you to risk what's maybe 75, 80% downside from here just to hold out hope for what could be, 50, 100, maybe more percent upside, I think just the risk to reward there is a little bit skewed at this point in time. It's one of those things where, maybe back down in the 40s, you didn't want to buy because you thought it was over. And then once it jumped back up to 150 here, that's potentially confirmation for you that, the squeeze is back on and you would buy in right here. And then obviously you would have been the beneficiary of that as it ran up to 350. But I guess if you are thinking of entering GameStop, my question to you would be, if you didn't like it after the initial pop at 120, what makes it more attractive to you now that it's over 2 times that price? And that to me is where there's a little bit of a disconnect about entering at this level if it's not a play that you're already in on. So I guess to summarize our thoughts on that one, we think probably in the short term we could see a little bit more action from GameStop. But if you're not already in on a position, I think this might be a decent time to get out. So that is our thoughts on that one. Back to the chat. We're just going to keep running through suggestions that they come through the chat. Our next one is about, I did what you mentioned on Clover Health, bought the 1250 March calls and sold the April calls for $10. Got my cost down to $9.50. And that's really solid there from Todd Miller in the YouTube chat. When you go to CLOV, what we saw was some pretty nice price action right there. And to have your cost basis down at $9.50 is really not too bad. I mean, obviously it sucks when Clover Health has gone down from, 13 plus all the way down to 630, but it's pretty encouraging seeing that there is a nice little bump in the stock lately to have your cost basis at, let's see, what is it? It's roughly 950 is what you said in the chat right there. That's a decent place to be. I mean, things like this we say so often that when they go down this quickly, and we could zoom out even further because it had to even further drop from the 13 that we're looking, that's dropped from a peak of $18.04. Things that drop this quickly do tend to spike up just as quickly, and I think we could definitely, or at least hopefully from our perspective, since we're also in on this one, see this $10 level again. And like you mentioned, that cost management that you did with the April and March calls is awesome, and for you to be sitting with the 950 basis, I think is plenty fine for the maybe not the long term, but at least the next month or so when those options will expire, and you'll get another chance to readjust your cost basis and bring it even further down. So again, we're going to kind of do what we did last night. If you have a stock that you want us to take a look at, we're going to make a running list and go through those as we can. LAZR is going to be up next from Typical Tangerine 26 in the Twitch chat. Thank you for throwing that suggestion in, and thank you for tuning in with us tonight as we go through this. And one sec, we've got some more. We've got NIO, FT, and then TIGR from Jules. Thanks again, Jules, for those suggestions. So next up, we've got Laser, LAZR. Let me edit this text graphic that I've terribly overlaid onto the screen right here to show that we're going to be talking about Laser, and we'll bring up the chart really quickly. Okay, so Luminar Technologies, this was another SPAC where when we zoom all the way out on the chart like this, we see this cost basis. Oop, that was zooming in 1 minute. We see this $10, just below $10 price floor. 945 trades there for so long, and this follows the typical life cycle that we see with a lot of these SPACs where there's some deal rumors, the target is announced, and then we really start running up. Peaks at $47.80, which is honestly off a $10 net asset value on the SPAC. A huge move. And then after the merger, sold off pretty sharply down to the low 20s. Did bounce back up into the 30s where it was relatively steady for a while. It looks like between the end of December all the way up until February 19th, it traded in that low to mid 30s range, which is decently steady for a stock that's had a run up like this. But in the meantime, between that February 19th point right here and now, obviously, as you could see on the chart, dipped all the way down to 20 before bouncing up to 26 again. First impressions looking at this graph, just doing a little bit of TA. Obviously, we do say that we don't get too deep into technical analysis because a lot of it I feel like is a little bit overblown. But one thing that I think is super important are areas of support and resistance. And even just looking at this 1 year chart, we could even zoom back into the 180-day chart here. This might get a little better of an idea. You could see these areas of support and resistance on the chart. For example, there's a peak right here, there's a peak right here, and there's a peak right here. And these are all in the 39 range. So you could have used that as a potential point of resistance when you saw, okay, it peaked here, it peaked here. So when it's trading around here, we would have potentially surmised that our short-term point of resistance again would have been that similar 38, 39 level, and it would have been correct. And that same goes the other side with support for where a stock's going to bottom out. We could see that it Helmsy1, thank you for the follow on Twitch, and that's another guy from our Discord. Awesome to see you in here. So going back to the idea of support, we could see where it bounces off, 30, bounces off 30, bounces off 30, bounces off 30 again, and then goes back up. And that would be one where if you were trading in that low 30s range, you could be, we saw 30 as resistance, exactly what we're going through right here. So that was one, a lot of people were comfortable trading in that range for a little bit of time. And then as you can see, when it finally did break that support of 30, it was a decent way down. And we know that when support is broken on the way down, it becomes resistance on the way back up. As we saw when it tried to recover and get above 30 there, it fell back down to 20. And when we want to look again back at these areas of support and resistance, we could potentially see that off the initial drop post sell-off, 21 was the bottom. And coincidentally, you look back over to earlier in the week, roughly 2021 was the bottom again. So that's how we use those concepts of support and resistance to find good entries, good exit points, and give ourselves realistic expectations of where we think that a stock can go in the near to long term. So with it at 26 right now, let's see what the situation was. Cost basis of 31.42, slowly whittling it down with covered calls. And we just want to look at some analysis and opinion on it in the near future. Going to the Analyze tab, this is one we always do if you follow us on the streams. This just gives you a good overview of what the company looks like. Obviously, they have just gone public with via the SPAC that they used to go public, so there's not a ton of detailed financial info that we could dig into necessarily. But they're an autonomous vehicle and LiDAR technology company for passenger vehicles and trucks. Something off the top of my head is that I always do like to invest in, I guess you can almost call them futuristic companies like this, because things can dip in the near term, but long-term perspective wise on a stock like this, when you're working with a company that is developing things for autonomous vehicles, obviously widespread adaptation of autonomous vehicles in our society is a little bit down the road. So people are always going to have some sort of speculative bullish outlook on stocks like this, because the applicability of them to the consumer, once we finally start adapting these autonomous vehicles, there really isn't a limit on how high something like this could go. So people are always going to kind of keep that idea in the back of their head and hold on to some sort of bullish sentiment, which is always great for futuristic stocks like this one. And as we could see in the options chain, another great one that has weekly options and decent premiums. I mean, you could get 1.86% out of the money just overnight on this one, which is nuts. And another comment in there, in the near term, 30 covered call would be a nice consistent way to unload it eventually. And I think those 30 covered calls are definitely a great idea. Even if we look a week out, we can assume this is probably what the weekly premiums will look like, 29.5. Let me get that 30 strike in here on the March 19th series. Scroll down here really quickly. Yeah, so you could see you'll be able to get about 80 cents of premium per week. And I don't know how far down you've whittled that cost basis so far. I know you mentioned that you got in at 31.42, so I'd imagine potentially that cost basis for you is somewhere in the neighborhood of 30 at this point, at least. That one it really just would depend on how long you've held it for, so I can't definitively say anything on that side of things, but down to around 28. Yeah, so I think the 30 strike call is a great idea for you if your cost base is around 28, because for starters, that would let you, if it did start running away from you, it would let you unload the shares for 30, in which case you're still getting a $2 gain per share on a 28 basis, which is a really decent return from a percent return perspective. And then if it keeps dropping a little bit back down to this level of support, you're still going to be able to chip about $1 off your price every single week, which means, next week you'll have a 27 basis, the week after that 26. And eventually with the amount of premium that something like this offers, you'll probably find yourself in a position where, either it's going to go up and your shares are going to get called away for a nice gain, or it's going to keep dipping, which is all right, but you'll keep lowering that cost basis week after week and find yourself in a position where your cost basis catches up to the stock price and you'll break even. I think this is a great one for that. I was a little bit wary of it in the mid 30s because, you could have conceivably seen some sort of short-term drop that was potentially upcoming, and that was finally realized. So I think this is in the scheme of things, a decent entry point. The other indicator that we like to talk about for a lot of the trades that we make here is RSI, which is the relative strength index. It would indicate that it's a little bit overbought at this level, but nothing, as obnoxious as the RSI levels we saw back on the initial run-up or any of these other run-ups before subsequent sell-offs. You could see it pretty much every time that the RSI on this one got in the red up to the merger date, it sold off pretty rapidly. It gets in the red right here, sells off, gets in the red slightly, but still sells off. And then finally back on February 16th, gets up into the red again and really starts selling off. And conversely, when it gets into the blue down here, which is oversold territory, it bounced up nicely. So, I mean, entry-wise, 62 RSI is, slightly overbought. So it suggests that you might get a little bit better entry in the near term. And it might drop a little bit more. But at the same time, this is such a safe play with these 30 strike covered calls. You know what you're getting, even if it does drop in the short term. Hey, that's a free 80 cents a premium. You'll just run it back again next week. And if things start getting away from you too much, you could even drop down to like 28, drop down to selling right at your cost basis just to try to, break even. And objectively, I think we get so caught up sometimes trying to sell above our cost basis that we forget the fact that, hey, I got into a trade at 31. This thing's dropped to the mid 20s, which is a pretty decent dip in the stock price. But people get so hung on to the little bit of a sunk cost fallacy wanting to pull a profit out that they lose sight of the fact that even if you wanted to sell lower than 30 and get down to a 28 strike, you would be able to get out for a break even on a trade that's moved almost, 10, 20% against you. And I think that's pretty damn solid. So suggestion for now would just be to keep whittling away with the 30s. And if things continue to drop, maybe reassess the strike that you're selling out on that one. J Mart's in the chat bringing up GE, so we'll add that one to the bottom of the list. Next up, we are going to talk about NIO, a suggestion from Jules. Hopefully you're still on as we go through this one. So let me update my crappy little graphic in the bottom of the screen to NIO and take a sip of water, and then we will get on with it. All right, so another one here in the maybe not autonomous space, but the electric vehicle space. This is one that has a decent foothold in what is really one of the largest consumer markets in the world in China. So they're kind of, some would compare them to being the Tesla of China. They may not have all the offerings of a Tesla, but as far as getting electric vehicles to the market, they've done a solid job of that so far compared to some of the other, electric vehicle speculative type companies which have no sales. NIO has at least sold, thousands of cars. So that's something that they have that, puts them a little bit above some of these other speculative EV names, and really not a bad name to play, but there's been so much action on this one lately, as we could see from the 180-day chart. So let's talk about it. And then we got a suggestion to run through IPOF from Helmsy in the chat, so we'll throw that one on the list and we will get back to that. I will not forget about it. But to NIO, as you can see, obviously pretty big drop off the top, and I do want to pull up Tesla's chart really quickly because I think these two are really strongly correlated. You see this big drop and subsequent rebound pretty much right back to where it was at the end of February, as if this big drop right here at the beginning of March never even happened. And that is the same pattern we just saw when we pulled up NIO's chart. So I guess for a little more, maybe better idea would just to talk a bit about support and resistance. We saw maybe a level of support that we wouldn't have foreseen because there wasn't really a big, base at this level. So almost surprising that it bounced off of here, since that kind of corresponds. The last time it traded at this price was just when it was on a straight line up back in November. But we might run into a little bit of resistance. I would say probably in the 50 area, not only because there's a peak right here near 50, there's a peak right here near 50, but also because round numbers like that, funny enough, they can almost act as psychological barriers in the sense that, everyone is going to put a limit sell order at 50 because, okay, I bought this stock at 40. I want to lock in a 20% gain. I'm going to purchase the stock, put in a limit sell order at 50, and then I'm going to just let that sit. So when this stock goes back up to 50, all these limit sell orders get hit and it just keeps getting knocked back down off that price, which is something that you see around here. You might see around here. I mean, initially it broke right on through without much of an issue, but then subsequently got smacked back down. But that is always something I like to keep in mind. Those big round numbers, like, if something's getting up to 100, or if a lower cap stock's getting up near 10, that might be kind of a harder border. But with NIO trading at 46.45, after hours closed at 46.03 during normal trading hours today. I think there still is a little bit of room to run back up to 50. I think a lot of this market sell-off was a little bit overblown, but at the same time, it is important to consider overall market trends. And we could pull up the S&P 500 index to get an idea of, in general, there have been, little dips and peaks and valleys and troughs over the past 180 days. But in general, it's been a pretty smooth ride upwards, which does give me a little bit of pause. Because if we zoom out to something like the 3-year chart, every now and then, this is looking back at beginning of 2018, where we saw a drop from 293 down to 230 in the S&P 500. And then obviously we had the COVID dip, but we really haven't seen, save for a couple dips right in this area between August and the end of October. We really haven't seen any decent pullback in the market. And it's not like things are already going so well. You can make the argument that, okay, the Fed has implemented these quantitative easing measures, the QE, that they essentially are using to pump banks and institutions full of liquidity to prevent any similar drops in the near future. But at the same time, I do think the Fed might be running out of options a little bit. Lowering interest rates is another thing that helps the stock market, but our rates are pretty low and there's not much further down we could go. So I think raising the rates is something that may be on the horizon, not for this year, maybe not for 2022 or even, but sometime in the next couple of years that could happen. My little thesis on that is that once rates get raised, we're really going to see a decent correction. But it's always important to think about not only the entry on your stock, but what things are looking like in the broader market. So I do apologize for going on this tangent a little bit, but I think it is something that's important to keep in mind when you're just thinking about trades to enter. How much cash should I keep on hand to enter a trade? When should I try to time the market? Which, short answer, you should not try to time the market, because I felt the same way about us being overextended here, and here. But of course, we blew all the way through that, and theoretically, there's nothing that would stop us just from taking a straight line up to, 500. However unlikely that may be, it is a possibility. Time in the market is way better than trying to time the market. And what may go against that logic right there, Jules says QQQ looks like it might be forming an inverse head and shoulder on the 17th FOMC meeting happening. Got a lot of these potentially, bearish catalysts that are coming up. The stimulus got passed. We're probably not going to see any sort of government stimulus beyond what we just got signed in. So this almost seems like it could be the peak of, euphoria in the market, where we bounce back from such a severe drop. We went from 390 down to 370 in about 2 short days, and all of a sudden, less than a week later, that's all been forgiven. That's something that gives me a little bit of pause, because the biggest green days kind of come during the bear markets, so that's always something I'm a little bit hesitant of. But it's trading in a really nice upward channel. We broke through the all-time high today, I believe. Maybe we topped out at the all-time high, which is another thing that's really important to, further the discussion about support and resistances. We pretty much bounced right off the all-time high today. So with that in mind, while I do think NIO is due for a bounce, I tend to believe industry sector-wise, electric vehicles, the valuations on them are just not terribly sustainable or based in any sort of numbers. You might be someone who argues that, maybe these insane valuations we're seeing in stocks like this, that is kind of the new normal. And I would never tell you you're right or wrong on that, like we say all the time. We could totally I'm trying my best not to be a bear asleep. Yeah, all my positions are long. I'm just maybe it's more of a discussion about how much cash to keep on hand. But like we said, we like to say all the time, it's okay if you have different opinions than us. All of our opinions about the market aren't going to be correct. If they were, we'd be rich. But at the same time, I think it's important for us to kind of maybe put things into context, because a lot of newer investors, not claiming that anyone here watching is just super inexperienced or has no idea what's going on, but a lot of people have only been trading for the past, calendar year, and have only traded in these environments where things are really just moving upwards and these valuations are insane. But typically, historically, what we'll see in market pullbacks is that stocks like this, where the valuation kind of far exceeds what any sort of financial statement analysis valuation would suggest, these are the ones that get hit the hardest in pullbacks. Whereas, typical blue chip, energy stocks, things like that, those are the ones that maintain their value the best in a pullback. So something like this, especially, 180 days ago, this thing was trading at $6.50. Now it's at 46. This is one, and just the EV sector in general over the next few months, until we see some sort of decent correction in the market, I think it's starting to come to a head and may pull back. We've got someone in the YouTube chat at least admitting they're a noob, and hey, everyone was a noob at some point. I was not born, nor was anyone on this earth born with knowledge of the stock market, so you're definitely not alone, and we haven't done this for too long to forget what it felt like to not know anything at all. Thank you, Brenzy, for the follow on Twitch as well. But, let's keep it rolling into NIO. With this perceived risk, these little fake doomsday scenario that I'm talking about, not that it's a doomsday scenario, but these potential corrections in the market that I talk about with these seemingly overvalued companies may never even happen, and we may just, trade flat, have slight pullbacks, and then continue to grind upwards until the end of time. In the long term, the market is always going to go up. That's just how it works. So all of our positions pretty much are long, unless we're hedging something. So it's always good to have that long-term bullish outlook on the market. So if we do want to play that, and you might disagree with me in my assessment of NIO's valuation, what's a good way to do it? These weekly options that it offers are offering phenomenal premium, and a lot of that may be fueled by the fact that it went up. That might be a little small to see on the screen, but it went up 11.4% today. So that might have pumped some premium into these. But even when we were looking at 319, if you wanted to sell, just a 43 strike put, which is a decent, probably 6-7% cushion off the top of my head, that'll get you $1 premium, which is a 2.65% weekly return, which, as a lot of us know, compounds to a really nice annual number. If you sell that 43 strike put and you get $1.10 of premium, that'd give you a $41.90 basis, which is right around here. And that is a really nice discount off the current price. So, one of the games we play with the strategy of selling options is we don't know if we want to be aggressive and sell something here, which gives us a nice return of 5.41% in a week, but is significantly more likely to finish in the money. And we could pull that probability up. I just missed it right there, but we could pull it up right here. This one has a, I guess we should say probability. Am I losing my mind here? Probability out of the money, which is what we want. So, this one has a 50% chance of hitting max profit at 5.4%, or do we want to get a little bit safer and play something that has maybe a 2% return, but there's a significantly higher percent chance of you hitting max profit at 74.24%. And again, that's another area with this strategy. I'm not going to tell you one way is better than the other. If you're extremely bullish, this might be where you want to go. If you maybe share my outlook on this kind of a stock and think, okay, we might see a pullback in the near term, you might set yourself up with something that's higher probability, slightly lower return, but hedges that downside risk a lot more effectively. So that part is really up to you, just depending on your outlook. I do think it's not a bad stock when we talk about it in the context of our strategy, obviously, because this return on risk is so nice. But, Sleepy in the chat mentioning, is NIO going to be our short collar target? That's a good question, and I think there might be a little bit too much upside risk on that one for me to be confident enough to open a short collar on it. But we can continue to discuss our short collar targets. That's definitely a strategy I want to try to employ sometime soon. It's something I think is a little interesting, and maybe we could build out a strategy with the short collar on the stream here sometime soon. But that pretty much wraps up our assessment of NIO. Again, one that if you are bullish on, and it's perfectly valid for you to be bullish on, really solid weekly returns. Just selling cash secured puts, running our HT wheel strategy is going to be a great way to play that one. If you are bullish and still share some of the hesitations we have about maybe the stock or the industry or the market itself, going further out of the money with a higher probability play, which sacrifices a little bit of a return, but probably helps you sleep a little bit better at night, might be the way to go on that one for you. So moving down the list to another recommendation from Jules is going to be FT, and I don't know if I've heard of this one before, but nevertheless, we'll throw the graphic up on the screen, type it into the chart, and get rolling on it. Okay, Future Fintech Group Incorporated. And again, no idea what it is, so we are rolling right into the Analyze tab. Bad news, the Analyze tab has let us down, and it does not have a description of what this thing is or what they do, so we're going to have to hit up trusty old Google for this one. FT stock, Future Fintech Group. Uh-oh, it's another blockchain name. I should have been able to guess, Jules. I should have been able to guess. Okay, blockchain. I'm assuming they do some sort of I'm assuming they do some sort of either mining or some sort. Let me assume, if you know anything about this company, Jules, feel free to throw it in the chat. I'm just working under the assumption that probably this is a crypto mining company. There doesn't seem to be. Let's see what this article over here. This is kind of the base level of research I do to try to figure out what on earth the company is. If I have never heard of it before and Thinkorswim can't help me out, I'm sure this is probably boring you guys to tears watching me open up and watch these tabs load to try to get to the bottom of this. Okay, oh my goodness. So, Future Fintech was formerly a fruit juice company called Sky People Juice Group. All right, but management recently decided to pivot the company towards blockchain, and this may be one of the the funniest maybe business paths I've ever seen for a company to try to take advantage of a trend going from a fruit juice company to becoming a blockchain and cryptocurrency company. The ongoing strategy has included making acquisitions of Tycode, which I assume is a more crypto-based company. According to the press release, the deal is valued at 9 times trailing net earnings, which is not a bad multiple for that, which, you know, they mentioned that right there. Decent bargain. Let's see. Yeah, so a juice company turned blockchain company. I love the hustle. So let's take a look at the map. Let's take a look at the options. I know you mentioned that you have the 7.5 strike puts that are expiring, and I'm assuming those were probably entered into somewhere when those were out of the money. But, you know, nevertheless, that's back from... It had a good-looking chart at the time. Don't judge. Hey, Jules, this is a judgment-free zone, and for those of you that are in our Discord, Jules has pretty much full ownership of the Winning Trades channel, so... We will never judge Jules because I think she may have more winning trades in our Discord server than the rest of us combined. So she's a true pro, and if she thought FT had a good looking chart, then I will take her word for it. But looking in the scope of, you know, I guess taking a look at these 7.5 strike puts, which I assume are expiring on March 19th. We normally go nearest to expiry on these kind of things. I mean, biggest consideration right now is these are $1.40 out of the money. These are trading for, you know, $1.80 a premium. To make this a little bit easier, we'll have it calculated for us. But there's 40 cents of extrinsic value left on these, which, you know, we could pull the calculator up right here really quickly. Try to pull it over into the window. I didn't want it to take the whole window, but that 40 cents of extrinsic value divided by, what's 7.5 is a 5.3% return on those over the next week, which is really, really not bad at all, but that's also assuming Cassadian, I'm going to go with Cassadian pronunciation on that one. Thank you for the follow. Feel free to correct me in the chat if I butchered the pronunciation. I feel like that is definitely one area I've been terrible at. But like we mentioned with the calculator that we had pulled up right there, it's a 5.5% return if you just hang tight with those and it stays flat. But looking at this chart, the better question might be, is it going to stay flat? It looks like we might run into a little bit of resistance here at this peak that we saw at the beginning of March in the 630 area, but if they get past that, there's a decent gap right back up to that 750 level. So, not just pulling that additional 5.5% premium, but if you do hang tight for a week and it gets back up to 750, you're sitting on a 31% gain between now and next Friday. So, I mean, if you've got those, you might as well let them ride out. I don't see a reason not to. The only thing that I would maybe potentially be hesitant about on this trade is if you were planning on entering into the wheel with it and taking assignment, you'd have those shares. I don't know exactly what premium you got, but I would assume that you maybe have them with the basis roughly in the 650 area, somewhere around there. And Jules is holding. She's holding on tight. I love to hear it. Keep it rolling into April. But if you do take assignment, we're just going to assume for purposes of this example that we're rolling with that you'll have a 650 basis. If you want to sell above your cost basis up here and take 90 cents off that to get down to what would that be? $5.60 is what that would immediately make your basis. Even just that puts you with the basis right here. 560 is right around there for the next calendar month, which a month back from today on this chart is right where's the 11th? Right here. So in the same time frame between now and when that April call would expire, if we applied that time frame retroactively, looking at the chart here, what we saw was a movement from 6.5 up to 11, back down to 4, and then up to 6.13. And that's something where with a stock this volatile, sitting there steady with the 560 cost basis might be a little bit of a teeth grinder right there for 30 days with that kind of position. But hey, I mean, if you're holding on, I absolutely think that's the best idea, since we like to assume things will trade flat when we evaluate our potential positions. But as we saw here with this 40 cents of extrinsic value, if it does trade flat, you're pulling a 5.5% return on that. That's not too bad. If it jumps up to 750, you get the added bonus of a 31% return over the next 8 days. So I don't hate the risk to reward on that one. The only thing that I would potentially be cautious on is what seems to be, to me at least, a lack of premium on the call side of things for the perceived downside risk, considering that just back in January, this thing was trading at 176, but of course, that was probably back in their old fruit juice days. So of course, they're a new company now, right? But that is, I guess, our take on FTFT. If you do have that 7.5 strike put position, maybe we'll revisit that one next Friday. And we always like to root for everyone in our group and all of our followers, so we're hoping we see 750 on this one next Friday. So moving on to the next one on the list is TIGR. And I will once again update the graphic in the bottom left to represent TIGR, and we will pull the chart up. Oh man, Jules, what are we doing? This is another fun looking one where we've had some, some pretty boring price action from, 586 up to about $40, back down to 16, up to 24. So I mean, I guess, I don't know, between February 3rd and now the price hasn't moved. We could phrase it that way to make it sound a little bit less exciting, but as you've indicated in the YouTube chat with some of those emojis, you are all about the roller coasters. I love it. But this is one that was up 23% today. So in terms of an entry, I mean, definitely not a place I think we'd enter, because as we can see, the 22.5 strike puts, hey, those are out of the money now. You're back to max profit territory. So today was a great day for you then. I'm assuming those probably are also the March series, the 22.5. Yeah. So you're going to pull another 8.7% premium just if that stays above the 22.5 level in the next week. I mean, this probably wasn't too fun a few days ago for you when this thing was trading at 16, but I guess one of our favorite things to say is if you don't like a position, just wait. And that's definitely come true with this one. I don't even want to ask when you got in on the 22.5 piece, so maybe we could keep that one to ourselves. But let's see. Is the stream working for you guys? On the little preview I've got, it still frozen on where I was talking about NIO. So if it's still working, let me know. Hopefully that's just a little glitch on the stream that I've got on my side. You're at a $1,200 loss yesterday, but we're going to be able to forget all about that $1,200 loss because it's working. Appreciate that, Helmsy. Appreciate the feedback. We're going to be able to forget all about that $1,200 loss. And I mean, you might even be, depending on where you open it, in a gain on the position, but this is one where we're just going to absolutely love that potential IV crush and theta decay into the back end of this one, where over the next 6 trading days, as long as this thing doesn't move, you're going to be dropping $1.80 of premium off this day by day by day, which is an 8.7% return in a week, which, you know, we typically like to aim for between 1 and 3% potentially per week. But, you know, if you could pull an 8% return in a week, more power to you. But, you know, going back to the Analyze tab, because we haven't even jumped in. We just looked at the chat. I have no idea what they even do. Oh man, oh man, oh man. They're a leading online brokerage firm focusing on global Chinese investors. The company's trading platform enables investors to trade in equities and other financial instruments. I wonder what those other financial instruments could be. Could it potentially be crypto, Jules? Do we know anything else about this company other than what's going on right here? Another thing we like to do, we could take a look at the news as well. Let's see. Hey, I mean, they were initiated with an outperform rating with a 30-60 price target back on March 5th. So that was down here. Someone gave them a $30 price target. So I never hate trusting the analysts. So maybe we've got a good play in our hands on that one. But if you're looking, for those of you who are not already in this, obviously Jules does have a position established. But for those of you who are looking for a position, this is probably, no offense to Jules here, but not the greatest entry of all time. RSI, the indicator that we love to look at, is extremely elevated, up to 81.45 on the 20-day chart. And the last time it got this high was back on February 16th, where it went from 38 down to 30 over the next couple days. So this one could probably be a little bit of a roller coaster for you, Jules, over the next week. But if you've got the means to hang on, by more power to you, and let that IV crush and theta decay go to work for you. So we've got another suggestion in the chat, OTRK. We're going to throw that on the list. Next up, though, is going to be GE, General Electric. So we're moving. This is going to be quite the shift in focus from us, going from these juice company turned blockchain companies to General Electric. A little bit of a risk trade-off in discussion here. So I guess, well, maybe I should take back what I said about risk, because this one has dropped from 14.4 to 12.2 in the last 2 days, which is really, you know, unusual for a stock like this, because you zoom out, obviously it was trading, I mean, back at 6 in September and October over in that area. I'm not entirely sure. Again, J Martz, I know you recommended this one in the chat. Feel free to throw any context in there for me if you've got it on why this one either ran up so far in the first place or took a pretty steep dip over the last few days. Is this dividend actually, it says the dividend is 1 cent. I don't know if that's actually accurate. I don't know why anyone would even bother paying out a 1 cent dividend, but hey, that's what it says. The 180 chart, we've got the RSI in oversold territory. So awesome entry here potentially. We've got weekly options, I know. And, you know, even something like a 12 strike would pull 1%, just under 0.71% return overnight, which is great for a stock that, you know, is maybe not steady on a day-to-day basis, but in the long run, not the worst long-term hold. Even at the money, cash secured puts for next week, those are pulling 2.39% for just out of the money. If you want to get a little more aggressive and go 12.5, they pull almost double the return, which is really not too bad of a value proposition right there. But again, let's take a peek at the news, see what caused this sell-off here. Let's see. We're going to pull this up and make it a little bit easier to read. So, okay, GE stock suffering the biggest drop in 9 months as Analyst Day disappoints investors with high expectations. So again, if we click on that, it'll bring up the news feed, and we can kind of skim through the story real quickly and kind of get to the bottom of what's going on here. Deutsche Bank analyst sees investor positioning as a reason for the stock weakness. Oppenheimer, they downgraded on valuation concerns. Let's see. The extended sell-off comes after GE announced a $30 billion deal to combine its aircraft leasing business with AerCap Holdings and surprisingly proposed a 1-for-8 reverse stock split. That is interesting that they would want to have a reverse split. So, normally a stock split, as we've so famously seen recently with companies like Tesla, is when they will issue essentially more shares and that decreases the value of the stock. A lot of the time, the rationale behind that is to make shares more affordable for everyone. As you could see with the Tesla stock split, it worked. With the reverse stock splits, it's the opposite. They'll essentially take a portion of everyone's shares off the market, but that in turn will increase the company's share price. So if GE was proposing a 1-for-8 reverse split, that theoretically would multiply their stock price by 80, getting them up to about $96 a share, which is, I'm not certain what the rationale behind that would be, which I think whoever wrote this article was equally confused because they mentioned it was a surprising proposal. But that is typically something you'll see. A lot of NASDAQ stocks have listing requirements where they have to be above, $1 to remain listed on the stock exchange. So if they don't hit that, and a stock's trading at, 70 cents a share, sometimes those companies will undergo a reverse share, which will get them up to the minimum price requirement to be listed on the NASDAQ. But for a company like GE, that's interesting. I'm not really sure why they would want to do it. But getting back to, potential entry points here, obviously better than it was 2 days ago. But how far could this thing fall? It looks like potentially this ran up on, high hopes for the future. That's such a broad statement that it probably didn't even add anything to the conversation. So feel free to tell me to shut up in the chat. But obviously there was some bullish sentiment here that caused the run up. And it seems like that was all coming to a head on Investor Day, at which point those potential bullish speculative viewpoints were not met, and those expectations, they fell short of those. And so the stock's tumbling back down. Now, typically you'll see a little bit of a bounce just because the sell-off was so sharp, and that's what the RSI indicates. But with sell-offs like this, especially if it is, not meeting the expectations that caused the run-up in the first place, we could see it get back down to the 10-11 level right here before we see any sort of leveling off or potential bounce from there. So that's not to say tomorrow it bounces up 5% just because it's dropped so much in the short term, but I think maybe 1, 2, 3, 4 week outlook here, we could see it come back to this 11 area. And if you are trying to get in on this stock, I would wait until we see something around this level. Just set a price alert. If it never happens, it never happens. Better to miss out on a good trade than be stuck in a bad trade. And there's so many stocks out there. We talk about a bunch every night. So you're better off to just hang tight, maybe wait for this one to get to 11, because I think that's where it's headed next. And we could revisit it at that point with the facts that we have at that point in time. So that's the spiel on GE. Checking back to the chat, one question in there is, how exactly would that affect the stock owner for GE? Would investors gain from the reverse split? And the answer is no, and I could quickly illustrate this in the little Google sheet that we've got up here working. We can just go down here and do scratch work. So let's say you own 100 shares of, let's say you own 100 shares of GE, and it's trading right now at $12.27. So that is going to be your shares. We can zoom in even further on this. I know sometimes these numbers get pretty small on the stream. 100 shares at $12.17, so that's going to be the stock price. So the equity, or the amount of cash that you have in this trade, is going to be 100 shares times the $12.17 share price, meaning that you've got $1,217 tied up in the trade. Now, what would happen in an 8-for-1 reverse split? So what would happen is that they divide the number of shares that you have by 8. So you wouldn't have 100 shares anymore. You'd have, 12 and a half. The way fractional shares are, measured. Maybe we'll make this 800 to make it a little bit cleaner of an example. So backing up, you have 800 shares at a 12.17 price. That's $9,736 worth of shares. So what they do is they issue a reverse split, meaning they essentially divide the amount of shares you own by 8, as opposed to a normal split where they would increase the shares you own. You own 100 shares now, but instead of this being at 12.17 like we mentioned with the reverse split, it's a mechanism to prop the stock price up. So this is going to get multiplied by 8, which means that you now have 100 shares at 97.36, which is the same exact net effect. So you owning 800 shares at 12.17 on a equity or cash basis is the exact same thing as you owning 100 shares at 97.36. The only thing fundamentally that changes here from the investor's perspective is the stock price itself. Now, on a psychological level, whether or not, that's a good or bad thing, I tend to think reverse splits are a bad thing, because there is, while, in theory, it doesn't affect the valuation of the stock, it's still valued the same when there's this many shares trading at 12.17 as opposed to an eighth of that but trading at 97.36. I think a lot of investors get spooked with these high price points, because if you've got something that's trading at 12.17, there's not a long way down. It could, how low can a stock go? It could just go to zero. Conversely, if you've got a stock that's trading at 97.36, that might spook investors a little bit, in the sense that, okay, this thing's trading at 97.36. There's a lot further of a way down than there is when it's at 12.17. Now, from a valuation perspective, that's just fundamentally incorrect, but we know that the market is driven by buying and selling. So just because someone's thesis isn't based in something that's maybe academically correct, doesn't mean that they're not going to trade based off that. So I do tend to think that reverse splits are not the greatest for, stock price or stock valuation or investors in the stock in the long run. So moving on, oh man, I forgot to update the graphic on this one. It still says TIGR. You guys got to keep me honest. Next one on the list that we're going to be talking about is going to be IPOF. So this time I will actually update the graphic. There we go. That one should be up to date with what we're talking about. Let me scroll back up in the chat really quickly, because the question was from Helmsy, what's the best strategy for IPOF? He has 15 strike puts for 319. I was thinking about just rolling them out for the same strike until the news comes out about the merger. So this one, I think, while using your cost basis is helpful sometimes and sometimes it isn't, this is one that I do think would be helpful to know what exactly your cost basis would be if you sold these 15 strike puts for $1.50 and you're sitting at a $13.50 cost basis. The advice might be a little different than if you were, sitting at like a 10 cost basis. So I think as I go through with this example, feel free to chime in and let me know what your actual cost basis is with those 15 puts. But I think a decent conservative estimate that we can go forward with here during this example is that you've got a cost basis of $13.50, and you don't know whether you should roll or whether or not you should, take assignment, sell 15 calls, sell a different strike, yada, yada. And my advice here was, if you can afford to take assignment, I would take assignment with that $13.50 basis. You could then turn around, break even price, even better, $13.23. Perfect. So I would recommend letting yourself take assignment if you can afford those shares at $13.23. You then would be able to sell a 15 strike put. And what's interesting here is you might find yourself in a little bit of a dilemma. We could go right back to the spreadsheet to talk about this one. Get on more scratch work here. So your basis is going to be $13, and actually, how do I want to do this? We'll do it right here, whatever. Your basis is going to be $13.26. So you've got two options basically once those get assigned. Probably the more conventional way to do this is sell the 15 strike call for what we can call 50 cents of premium. So if we sell the 15 call, we're going to do option 1 here, which is going to be the 15C. Option 2, Westwind Winner, appreciate that comment. Always happy to have you in the chat. I know you were on for the very first stream we ever did, so awesome to see you back in the chat. So option 2 here for IPOF is going to be selling the 12.5C, which might be a little counterintuitive, because you'll say, you know what, this 12.5C is below my cost basis of 13.26. Why would I do that? We'll get to it. And Westwind, appreciate that donation. That's awesome, man. And hopefully, yeah, we'll try to get that message staying up in the screen a little bit longer, so we can keep those meaningful messages hidden up in the top right for donations. But really appreciate you being on the stream. Appreciate the donation. We'll get back to IPOF. Keep it rolling. So your basis is 1326. We know that's going to be consistent across option 1 and option 2, and we could even zoom in a little bit further because I've got these big monitors in front of me. I never know how big it is for you guys that are watching on either your phone or computer, but hopefully this is big enough for people to see. But here is your basis. This is going to be your basis no matter what once those shares are assigned. So option 1, I think I've said option 1 about 10 times without actually getting into what the option does, but now we'll actually get into it. You could sell the 15 strike, which will give you 50 cents of premium. So the amount of premium we know, new cost basis, it's going to be a direct reduction of your cost basis. We should probably make that a decimal. We're not taking 50 away, but your new cost basis here is going to be 1276. So if you sold the 15 and you get called away at 15, your gain per share is going to be 15 minus 276. You'll have a 224 gain per share, which divided by your 1276 basis is a 17.5% return. So we'll call this gain per share. We'll call this return on capital risked. But you've got to, also keep in mind how likely is it they get us back to 15 by April. And this is another one we could pop right back here. Some of these theoreticals. You have a 19.25% chance of that hitting. So to kind of illustrate probabilities as well here, you have a 19.25% chance of max profit here. Now option 2 is going to be this 12.5 strike call, and as I mentioned when we are kind of at the top of this, you might say, why am I going to sell a 12.5 strike call? My basis is 1326. I want to sell above my cost basis. And here is going to be the answer to that question. So, IPOF, it's no secret, this thing has dropped pretty hard since it was first recommended and when people have been getting in right around this level right here. So, objectively, that part of it sucks. How are we going to dig ourselves out there? That's what we've got to focus on, and that's what this is going to help us do. You might get to the point where, you could stick with option 1 and say, you know what, I like this 15 price point. I think they're going to announce a nice target. This thing's going to spike. And again, perfectly valid investment thesis to have, and this is a great way to play that. But you might say, you know what, this thing's dropped, 20, 30% on me in the last 3 weeks. I'm tired of this. I want to get rid of it, but I do want to get out with a decent, I want to get out with a profit potentially, or just as close to break even as I can, because anytime that you could get out at break even on a trade that's moved 20 to 30% against you, yes, it sucks when a trade moves against you that far, but to get out at break even or a small profit is phenomenal for that significant of a price movement against you in the short term. But we are, as we continue to talk in circles here and not actually get to what we're doing, the 1250 strike call goes for 87, we'll call it 87 cents, the midpoint between the 85 bid and the 90 ask right here. So that is going to be an 87-cent reduction of your cost basis, meaning that your new cost basis is 1239 here. So if these are called away for 1250, it's actually a gain because the premium you get from this, even though your current basis is 1326, 12.5 objectively is below that basis, the amount of premium that 12.5 gives you sticks you back under that strike price, meaning that you're now selling above your newfound basis, which would stick you with an 11-cent gain per share if these are called away. And we know an 11-cent gain per share on a 1239 basis is tiny gain, 0.89% gain. But we like to talk again about what's the likelihood that something like this is going to happen. The likelihood that the 12.5 strike finishes in the money is 42.2%. And this is a much quicker path for you to get out of the trade if you've said, okay, you know what, I'm tired of IPOF. I just want to get rid of these. 12.5 strike covered call is going to be a great way to do that. And while you might severely limit the upside, by the same token, you're still pulling a almost 1% gain on something that's moved 20, 30% against you. And that is where the value of these option selling strategies really comes into play for us, and why I think this really isn't too bad of an option. I like this option 2 here if you really want to get out of it, but you got in this trade 3 weeks ago, so you might still be bullish. And I think anytime you're playing a SPAC pre-target announcement, you should leave yourself this kind of an upside, because we like to talk so much about the life cycle of a SPAC And we know that if there is a decent deal announced, we could see it return to these levels, which is coincidentally right at that 15 strike where you get it called away for an 18% gain, despite the stock pretty much trading flat in the amount of time that you've been playing it. So I think that is the way to roll on IPOF. Take assignment of those shares. Just keep rolling into those 15 calls. Lower that basis month after month. If something gets announced between now and April 16th, you probably could see a decent return. That question in the chat, same deal. Why would it not be a good idea to just roll out the 15 strike put? And that's something you also could do, and I think it would stick you with a similar return profile, because essentially calls, the big secret here, I guess, is that calls and puts at the same strike essentially work the same. And I think the best way to illustrate that is if we go to our potential trades right here. We'll call it IPOF. This thing will say, I don't know, it started at what, 1450 when you started trading it. It's down to, let's flip back here, 1226. And you've got just one that you sold, IPOF 319, 15 strike put. And you mentioned you sold it for 177 was the credit on that one. Currently sitting at 290. And what we would want to do is roll these. So you've got a 113 loss. Obviously, never exciting to have a 113 loss, but it happens. Not everything goes exactly where we want it to all the time, and you would want to roll these into the 416 15 strike put. So for those of you that maybe aren't following along with what we're doing here, when we talk about rolling options, what we mean is super simple. We're just closing the first option we had and then opening the same strike, but for the next expiry. And you might say, why would we do that? And this is going to be the answer as to why we do it. It's because you get a little bit bigger of a credit. So to show you what I mean by that, if we go back over here, you'd be able to close out the 15 strike put for 290. And the other thing I do want to mention is that extrinsic value on this, there's still 16 cents, not too much, so not a huge deal. But long story short, you'd be able to close these out for 290 and then sell the 15 strike for 330. 330. And that is a 40-cent credit, the difference between the 330 that you now have sold this one for and the 290 that it was sold for initially. So we know that if it gets back up to 15, this expires worthless. Let me drag this formula down really quickly. You're now at a 217 profit. We need to go to G10 to adjust the China Capital. D16 is where we need to go really quickly. I need to make this black text so you guys can see what I'm doing here. The amount of collateral on this play also is the strike price of 15 times 100. So that's the collateral. Return on capital. Why is this still G10? Needs to be G9. Sorry for working out the kinks of this. I took a row out of it today while I was making a TikTok. So fun fact about this sheet in my tracker. But you're getting a 14.46% return on your capital. Now this seems awful familiar, this 14.46% return. Oh man, now here's the fun part. What tab was I doing this on? To this 17.55% return. Now here is, I guess this really does illustrate why we want to do this as opposed to rolling the puts. When you roll the puts, as you can see, you only get a 40-cent credit, right? That 40-cent credit can be directly compared to the call premium for the options. So that 40-cent credit as compared to, the 50-cent credit you get from the calls, it's not as good. It's 10 cents worse. Now, what I will mention is that might be resolved by you potentially waiting till next Friday to do this when this 16 cents of extrinsic value is gone. That call premium might match up a little bit better with the credit that you would get when you roll the puts. And hopefully you kind of follow that explanation. I know sometimes I'll just kind of ramble and it'll make sense to me when I'm talking, but not necessarily the person whose question I'm trying to answer. So if you're following along with that, feel free to let me know. But long story short, the way things look today, the call is better because if it gets back to 15, you make 17.5% on these 15 strike calls, as opposed to where if it gets back to 15 on these puts that you sold, you're only pulling 14.46%, and that's the advantage as it stands right now. And again, just to reiterate, this 16 cents of extrinsic value that's here today and won't be there next Friday likely does kind of bridge that 10-cent gap. That is the difference between rolling the puts and selling covered calls. So As always, we do recommend waiting until the day of expiry to do that, so all of these extrinsic value situations are resolved. So that is our suggestion for managing that IPOF position. And we are going to move on to the next one that we've got on here, which is OTRK. I think that was the last one on the list, but I know Sleepy had a couple other Vestas and Siemens. All right. We'll add this to the list as well. Okay, OTRK. Let's pull up the chart on that one. Oh, wow. So this is one, I think, something in common with what we've seen for a lot of the stocks that get recommended here and a lot of the stocks that we've looked at tonight. Got from 20 up to 99 and is just absolutely fallen off the face of the earth. I mean, this thing was pushing 100 even just February 9th, a month ago, and now it is fallen off the face of the earth down to 23, where it has since bounced back up to 35. So, I mean, as we can see, we love to look at RSI, and this might be the lowest RSI that we've seen in these streams that we've done here. It got down near 10. That is just unbelievably low. And as you can see, when it did get so heavily into the blue there, it bounced back up nicely, which is to further the point of why we love using RSI so much as an indicator. But with me not knowing anything, step 1, analyze tab to OTRK. And let me back up to step 0, which should have been me updating the graphic on here to not say IPOF, but rather say OTRK. So there we go. Going back to the Analyze tab again, lost track. They're an AI-powered, telehealth-enabled, virtualized outpatient healthcare treatment company. They're throwing a ton of words at me right there. Their platform predicts which people whose chronic disease will improve with behavior change, recommends care pathways that people are willing to follow, and engages people who aren't getting the care they need. They'll identify and treat members with behavioral conditions that cause or exacerbate chronic medical conditions such as diabetes, hypertension, coronary artery disease, chronic obstructive pulmonary disease, and congestive heart failure. They integrate evidence-based psychosocial and medical interventions delivered either in person via telehealth along with care coaching and in-market community care. So really just, general healthcare. It does seem like they potentially use AI to give themselves that little bit of differentiator in that space, but just a general healthcare company. But there definitely is something that's going on lately because, as we've seen, this thing has fallen so far, which, may be good news for us because this looks like it might be a good entry point. We got a comment in there. This sounds like a bunch of techno babble from Marcus, and I mean, I don't disagree with you. Sometimes with stocks like this that have these crazy valuations when they're throwing all these different, we do AI, we work in the cloud, we do, we're on the blockchain. That's some red flags might be going off when you're reading that kind of a description, but let's check out the news and see what happened exactly here. It looks like the drop, that initial drop at least, was upon earnings where they had negative 32 cents EPS. That's not true. They had a 32-cent estimate and negative 7-cent actual results. So from an EPS standpoint, they beat. Let's see what's going on here. Why did they fall? I mean, let's see. This is 3.9. So I guess their earnings were on 3.9. I think this is just a mistake here. So let's get back to 3.1 on the newswire somewhere and see what's going on. I mean, did they have two sets of earnings? They looks like they have earnings on 3.1 and then earnings again. Okay, awesome. Thank you, One Tom K, for while I'm struggling around in here, he threw in the chat that they plunged after announcing the loss of an Aetna contract, which obviously for a healthcare provider being connected with an insurance company like Aetna is a huge potential source of revenue. They said they have a strategy in place to regain the on-track A business and currently are in late-stage discussions with other customers, so they potentially believe that they will get that money back. Off the top of my head here, looking at this, it's tough to say exactly how much of that, the potential valuation was based off people assuming they would have a contract with Aetna, but it looks like RBC Capital analyst They downgraded on track to sector perform from outperform, moving the price target down to 32, down from 82. That's insane. Important to note, though, that while they still think opportunities across the behavioral health space remain large, I think the loss of Aetna, their largest client, is not only a significant headwind to revenue, but also the growth outlook. And obviously losing your biggest client is a pretty big speed bump. And that revised price target that they had was at 30. I already forgot what I looked at here. 32. So from the people who covered this, the analysts, it's already exceeding that revised price target. So to me, that would suggest, I think this is probably an area where that loss of revenue is accurately priced. This mid to high 20s area, because normally you see a big initial drop and things will fade off after initial drop. Sometimes when this happens during earnings, it's referred to as earnings drift, but you will see it with big news-based events like losing such a large customer. But typically what we'll see is it drifts downwards, will pop back up, and as you can see via the RSI, our favorite little indicator, back up in the red here, meaning it's probably a little bit overbought. This is a company that just had long-term growth outlook slashed. Not something I think I would be comfortable with investing in at this point. I think maybe if you do want to get on this one, I think you'll definitely find another opportunity below 30 at some point in the near future. So similar to what we talked about earlier with GE, set a price target at 30 or a price alert at 30. If it hits 30, get that notification. You feel free to enter that position, but always better to be to miss a good trade than be in on a bad trade. And I think you could find yourself potentially in a bad trade if you're jumping in at this level. What appears to potentially be a dead cat bounce where it's 50%, roughly, maybe more than 50% off the lows here, and elevated RSI. This doesn't scream good entry point to me. We could look at options as well. This is interesting. You can get a 10% return here. We like to talk about 30 as an entry point, and the cool thing about these cash secured puts are you almost get paid to make a limit order. So if you share that outlook and want to say, okay, I'll buy back at 30, what you could do is sell 30 strike puts where your basis first off would be 29. So it's the equivalent of you buying back at 29. But if this thing runs back up to, 40 or 50 and you miss the boat, you're still pulling a 3.6 or 3.36% weekly return just off that option premium. So due to the volatility and opportunity that provides, if that 30 range is somewhere you're comfortable getting in at, or the high 20s, that's going to be a really great way to do that. So I think that's kind of my 2 cents on that one. Never great, no shit, Jackson, but never great to lose all that revenue when your biggest customer walks out the door. The stock price reflected that, and a little bit of a dead cat bounce here. So I think 30 is a better entry range, and you could accomplish jumping in on that entry point by selling these 30 strike puts. And while they do only have monthly options here, this is one that expires a week from now. This is what's so great about being a week away from monthly option expiry is, if it were a week later, we had to wait till April, I maybe wouldn't be so confident about holding on to something like this for a month, but I think holding on to something like this for a week is plenty manageable. Looks like you sold the 22.5 strike put back on 3.5. That was one hell of a play, one hell of an entry on that. Do you think it's worth it to roll to the 30 strike put? I'm assuming, the 25, you got 15 cents a premium. You could bump that up to collect really another 80, 85 cents a premium. I think that one might just be up to you and how comfortable you feel about this stock in the long term, knowing what we know with the news that has come out. Because, we could look at what could potentially happen here is if it does drop back down to 30, let's assume you did roll up to 30, and you get a sign there with your basis would be 29 because there's a dollar premium minus the 30 strike. You'd have a 29 basis in shares. What would we be able to do going forward from there? And that is, sell something at maybe 35 or 30 again at your cost basis. And the premiums right now on calls are absolutely insane. You would be able, if you even sold at 30, that cost basis, you'd be able to knock $8 from this point off your cost basis, which would get you down to a cost basis of roughly 20. But I will say that analysis is a little bit flawed because if it did drop to 30, the calls would be most similar to what we see at the money here. So you probably would only be able to drop about $4 off. But even so, having a 29 basis off the worst case of you getting assigned here and then knocking 4 more would stick you with the 25 basis headed into April 16th. And, that seems like something that's perfectly manageable in the long term, and not even the long term, just over the next month. So I think I would give you the green light on rolling those up to 30 to collect that extra premium on those. I think that wouldn't be a terrible idea, just as long as you're comfortable potentially taking assignment and then running those covered calls for April. So that should be the end of the discussion there. Let me know if you have any further follow-up questions on OTRK on that one. But next up, we're going to go to Vestas, which I have no idea what the ticker is. Sleepy Condor left me kind of out in the cold on this one, where I'm just going to try to type a company name in here and see what comes up. It's got to be, okay, so we've got two here. We've got one that's trading at 192 and then an ADR trading at 64. Feel free to correct me if I click the wrong one here, but that one has no options. So maybe if we find one that does have options. Come on. And this one does not have options either. So this one is OTC, over the counter, which means there's going to be a little extra commission. Let me go back to that first one for Vestas we were looking at. The 192, that one is also over the counter. I may be on the wrong track here. I might not be looking at the stock you wanted to, but since this is Wind Systems and we talked a little bit about green energy last night, this may be exactly what you were looking at. But off the top of my head, this insane lack of volume on the chart, the fact that this is an OTC, there's no options to protect you. Unless you know something that I don't on this one, there might be a little secret info you got on that. This is probably one I would stay away from. And the fact that the Newswire here talks a little bit about it in 2019 and then goes back to 2011. The fact that we could see 2007 in the Newswire here, it looks like maybe lights on, no one's home on this stock. So this is one I would leave alone. But we can go to Siemens up next, which is the last stock that we've got. Unless we want to talk, we have someone in the YouTube comments mentioning they're down on Sundial, and we could discuss that one too. If you're still in those comments, give me a shout, and we'll be happy to go through that one next. So I'm assuming this is just the normal Siemens stock right here. Perfect. Again, no options. Let me hop into Google really quickly to make sure I'm not pulling up just something completely off base. Siemens stock is normally the best way to do that, and we will find that the ticker is SIEGY. That's another over-the-counter one because it's a German company, I think, and that's exactly what we had up right there. No options, so our discussion is not going to be able to include options, but at least looks like there's a little bit better volume than what we had on that last that wind stock. But backing up to the 180-day, we always like to look at the broader picture before zooming in and potentially picking an entry and potential exit point. So it's gone up a decent amount in the last 180 days. I mean, from 56 to 81. Nothing too volatile. I mean, we've got obviously some pretty big red and green candles, but even the biggest red candle we could pick out on the chart here is a decrease from 69 down to 64. So a $5 decrease. So the volatility definitely nowhere in the neighborhood of any of the other stocks that we've been looking at tonight. And for something with no options, that if you were looking at this as a long-term hold, that's a good thing. So let's back a little bit further up. They bottomed out at 30 pre-COVID crash. Let's check the 3-year to see if there's any potential upside beyond this. But no, it looks like they're trading at all-time highs right now. They were at the 65 range before the COVID crash, and they've far surpassed that now, getting up into the lower 80s. And just 50 cents off that all-time high we see there at 82. So let's take a look. I mean, maybe the analyze here might help us. SIEGY. There may be some sort of green energy based aspect to this if it's in line with the other suggestion that Sleepy had for us. But products and system solutions for automation used in discrete process industries, smart infrastructure. Looks like they have a hand in the healthcare. Here we go. Siemens Gamestop Renewable Energy, which designs and produces wind turbines. So they do have their hand in a lot of the wind turbine manufacturing, which is something that, I think we mentioned earlier in the week on our streams that we're super bullish on the green energy areas in the long term. And it looks like, tough to say how involved they are with that kind of green energy, but we could do something, just some really quick high-level research, type in wind turbines, and we'll see. What's interesting is it looks like there might be a separate security just for their renewable energy, SGRE.MC. Let's see if that pops up here when we type it in. SGRE.MC, and we cannot find the symbol. So that was kind of a dud right there. But that's probably something that's traded in European markets, so that might be why we're having trouble pulling that up on our end. But I would assume maybe SGRE itself can be what we're looking for. Bear with me here as I just get into a fight with the keyboard here, trying to figure out what exactly we're looking at for the renewable energy piece of this, because I do think that's the part of Siemens, from my perspective, that is the most interesting and potentially has the most upside in the long term for the type of thing that we're looking at. And it doesn't look like this is going to come up either. One little side tangent, looking at futures, we've got that in the top right here. We just had a little bit of a tick downward. That's a pretty big drop on futures, returning us to a level that we're at, I think, at the base this morning. So we essentially are equivalent now with what we were seeing at 10:30 this morning, which is a level of SPY that was 392. But we've got good news is we have a little bit of a hedge with SPX call spread. So if we could finish anywhere below these red lines that we've got drawn here, pretty much, they're going to be on SPX. As long as we can finish below this red line here, we'll be okay. And that futures movement suggested to us that we'd be opening right in this area. So that's not too bad of a cushion for us heading into Friday, which is what we always like to see. But in that discussion of futures that we always like to have, what the futures look like at 9:35 p.m., there's a world of time between now and Friday, tomorrow morning at 9:30 Eastern, when the market's open. So what we always like to say about futures is if they're going the way you want them to go, then they matter. But if they're going against you, then ignore them, because things can change in the blink of an eye. A lot happens while we're asleep over here. But looking at, going back into some preliminary research on Siemens and their wind turbines, not the right time to buy is what we've got right here. Trading close to its fair value, which is normally something that we like to see. We'll have to sign in to read the rest of that. We're not going to do that. What I would be interested to see is if we can get this renewable energy portion of Siemens stock as an investment. Siemens Games. We can just type in stock here. See if we could find something on that. GCTAF. Okay, so I think we may have finally found it. GCTAF. All right, now this is the one-day chart, but another over-the-counter stock with not a lot of volume, but this does appear to be what we were looking for in our initial analysis, where we saw Siemens had a hand in the renewable energy game. And while we could invest in Siemens overall, because we might think it's a steadier stock when you couple that renewable energy arm of it with the rest of what they've got going on, that really was the only part of their business, at least for me personally. Feel free to disagree. You might like what they do in, infrastructure type deals, but I thought that renewable energy portion is what was personally interesting to myself. So that's the part that I wanted to do a little research on. Is, as we found out pretty quickly from our research, you could just completely buy a stock that represents that by itself. And looking at the 180-day chart here, as we do so often, to get an idea of maybe longer-term trends that we're seeing with this stock. Went from 1694 up to 1465, and then kind of leveled out to this 36 area. So as far as an entry is concerned, Obviously when it got up to the 48.65, we're going to reference that RSI again. It got way, way, way overbought, quickly sold off, got back into oversold territory where it quickly bounced up from. And now it's kind of hanging out in the middle here at 51. And I don't think this is a terrible, entry point. It was up 7.3%. Today we like to enter things when they're red, so maybe this is another just keep an eye on, wait for a red day, and that'll be a good time to hop in. But in general, this mid-30s level doesn't seem terrible. I mean, if we do see a correction in the market, I could definitely see it pulling back to this 27.30 area. But this is a good time to mention the importance of maybe not dumping all the cash that you want to throw into a position into it off the bat. Because like we've talked about a little bit earlier, the market has just been in a straight line upwards since the COVID crash. We really haven't seen too severe of a correction. So while we do always think the market's going to go up in the long run, because quite frankly, it will, that's just fundamentally how the market works, that doesn't preclude the possibility of a short-term correction. And that's something we really haven't seen too severe of, since late October. And even this wasn't too crazy of a correction. It just was one that came and was quickly bought back. But it's been a while since we've seen some big red candles in the market. Even the ones we got the last couple weeks were quickly bought back. But that brings me back to the point of what we were just looking at with, was it SGR? Sorry, a ticker that I already forgot here. GCTAF. GCTAF. That brings me back to my point here, where, this is kind of in between the highs and then maybe an area where you would consider there to be a little bit more support in the mid-20s here. So potentially maybe if you had $1,000 that you wanted to invest into this, maybe only throw $500 in at this level. And then if it pulls back, awesome, you're in the 30s, you've got a much better entry point. And then if it runs up, it sucks you didn't have $1,000 invested at 36, but it's always good to have, $500 invested at 36, and you'll still reap the benefits from that perspective. So that's kind of the spiel right there on Siemens, where we were able to locate the separate renewable energy branch of that company. And not a terrible setup, but the way we feel about the overall market right now, maybe be cautious. Not the worst entry point here, but definitely a little bit of downside that we always want to be mindful of, and that is kind of where we will leave that. So here we go. Yeah, like Marcus said, nothing wrong with a little bit of essentially the martingale. And like you do mention, the HT wheel is kind of a glorified martingale where, we want to reserve a little bit of buying power, because on the way down, what we do when we enter into the covered strangle is, essentially we're doubling down on our position. And the great part about the market, it's not like you're in a casino where something can be black 10 times in a row. Everything is independent. There are these ideas of, mean reversion in the market. So, even if Apple drops here and you double down here to get your basis down here, it typically a stock like that's going to revert to the mean. You'll get all your positions resolved. You'll make money. Oh, if it drops, it normally comes back up. It's not going to be like you're sitting at the table, you get a bad run, and this thing just goes down to zero and you get cleaned out. The martingale theory of kind of doubling down when things go against you, when put into play in the market with that concept of mean reversion, where things are going to bounce back when they fall or subsequently drop after they spike in general, that is definitely one of the founding principles that the HT wheel strategy we've made is based off of. So that's why, going back to the stock we were just talking about, always a good idea to keep a little bit of buying power, a little bit of dry powder sometimes, as we like to refer to it as, just on the sidelines in case things go poorly off the bat. And, it's a lot better to be in a position where you're like, oh, shoot, I only had $500 in a winning trade than, oh, shoot, like I have $1,000 in a trade that's really gone against me and now I have no recourse. We love to have problems where we've made money and could have made more money, as opposed to problems where we're losing money and need to figure out how to get it back. So that is always the advice I'll give with buying power and things like that. So that does take us to the end of the list that we've been talking about tonight for the stocks. I think we're coming up on the 2-hour mark a little bit, an hour, just over an hour and a half on the stream. If anyone else has any other stocks they want to look at, feel free to let us know. I know we kind of jumped right into it tonight, so we didn't do too much of a recap of what we're doing this week, but it's been a great week for us so far. We are having one of our best weeks yet, and if this holds, all these prices hold, we're going to finish up with, I think, our single best week ever in the market since we've started these strategies. And it might be a little bit of cheating because we had such big losses that essentially our big gain this week is just us rebounding. So that might be a little bit disingenuous in that regard to say we had such a great week, because really when you look at our account balance chart, we're right back where we started 3 weeks ago. So we've just kind of been in neutral, but so is the overall market. But we've learned, like we have just harped on a little bit, some good cheap lessons about keeping buying power on hand, because back when the market dips, and I could pull up that SPY chart again, go back to the 20-day really quickly, I would have killed to have any sort of significant buying power down here. And we've got a comment from Chris in the YouTube chat about NOK, and we'll give Nokia a shout out, because that was one that luckily has been one of our more profitable positions this year, because just by chance we were able to be in on it before the squeeze and get out, even though the stock had decreased. The increased premium on the calls we sold allowed us to get out with a profit. But this is one, unfortunately, I don't think we're going to see. I mean, it just looks insane when you zoom the chart out, but I don't think we're going to be seeing anything like this in the near term. But, I think you could look at where it was trading before that squeeze, and it was right around in this range. I think this should be a decent base for the stock if you did want to kind of load up on this. And I wouldn't necessarily play the short squeeze thesis, and I don't think the market really believes the short squeeze thesis either, with the 6 cents of premium that you've got on the closest out of the money calls for the week. But it wouldn't be the worst thing in the world to chip away 6 cents a pop on what should be a pretty steady, strong. I'm at the point of the stream where I just start completely screwing up all my words here, but it's a pretty strong stock in the 5G area. They've actually are really, we talked a little bit earlier in the stream about when the market pulls back, those companies, they don't have good balance sheets, no good revenues to fall back on, nothing concrete backing up their valuations. Those are going to get hit the hardest. Nokia is an example of a company that has solid revenues. They have a lot of customers, really solid base, and a decent industry in 5G, which is getting bigger and bigger, and one that if we did see an overall pullback in the market, I think a stock like this would get hurt less. So if you do want to diversify your portfolio away from some of these just, insane stock movements that we've been seeing, if you're playing this for the excitement, and don't get me wrong, these offer great premium and there's some really solid value to be found in stocks like this, but you could almost, I guess, for lack of a better term, diversify by going into Nokia right here. So if the market does pull back and something like an NIO, which valuation is questionable, gets pulled back to a crazy number like 30 or something like that, you'll at least have Nokia, which should be staying a little bit stronger for you in the near term. So that's kind of the thoughts on Nokia. Definitely wouldn't count on a short squeeze. And I think in general, with any stock that we ever play, banking on a short squeeze isn't necessarily the greatest investment thesis, because we like to talk about, realistic high probability trades. That doesn't quite fit that description. But at the same time, I do think it's a decent stock, which in the near term, maybe long term, maybe quarterly, 2 quarters, 6 months from now, we could see it start to approach the 440, 450 level again. But that's definitely one you've got to be patient on. So that's one thing we do mention where diversity helps us a little bit. We've got, if one position's kind of dragging along a little bit for us, we've got 9 other positions that we could sit back and watch. But this one, if this is your entire portfolio, you might get pretty bored watching this one. It could be the equivalent of paint drying for someone who's running the wheel on this. And Todd, we do enjoy talking stocks, and we also enjoy everyone on here who's been talking with us tonight in the chat, giving us some feedback. That is the end of the list that we've got. So we're probably going to wrap the stream up right here. We'll be back on again, hopefully sometime this weekend. I know we released the weekly Trade Ideas newsletter, and we've started to try to do those live as we go through and formulate, not just analyze stocks from you guys and talk about the positions we currently have, but actually get into some of that analysis behind forming new trade ideas for the weeks going forward. So that's something we've added, and we'll try to figure out a time to do that on the weekend that works best for everyone. So that's something I'll be looking forward to, and that should be the next time we hop on. Tomorrow's a Friday night, and I hope I've got some stuff to do. Hopefully all you guys watching have got better things to do than sit on a stream and watch me talk stocks for a couple hours. So tomorrow off, maybe Saturday, maybe Sunday. We'll probably put out a poll to decide when is going to be best for you guys to hop on, because it is a lot more fun in here when we've got the chat going. We've got a lot of different trade ideas being thrown both ways, from me to you and from you to me. So whatever time we could pick out this weekend that works for me, where it works for the most people that are following us as well. Hopefully we can get something good with that going this weekend. And that's all we've got for tonight. Thanks again to everyone who tuned in and participated in the chat. I always really appreciate that. Again, the big promise I've made is we're not streaming to the biggest audience right now, but I think 75 viewers is the number we've got to get up to on Twitch to become a Twitch partner. So I think if we ever get up to that number, that's when I'll break out I'll go purchase a webcam, break that out, and get the full streamer set up so I could be looking like the pros. So hopefully we can keep on building what we're doing here. I think we've got a good thing going when we hop on a couple hours every night, every week, and keep it rolling from there. So again, thanks again to you guys who are in the chat, and we are going to sign off. This has been the Hourglass Trader, where as time passes, we make money. And thanks to everyone. We'll see you again on the next one.